What is your current assessment of the global economy and financial markets?
Financial markets are much more exuberantly pricing in that a soft landing or an immaculate disinflationary episode are the base case. I think that's wrong. You need to respect the fact that China is reopening, Adam. That's the second largest economy in the world. They have pent up stimulus from 2022. Consumers can now finally go around and spend it. They're not locked home anymore. And China is very relevant for global economies. So you need to respect that short-term cyclical growth push. But that doesn't mean that the tightening of financial conditions in 2022 and the delayed effect it has on negative effect it has on growth is not going to unfold. I think markets are getting too exuberant and they're extrapolating that this short-term cyclical growth push means that effectively inflation can come down, immaculate disinflation episode, while we can avoid a recession and everything is going to be fine. And I think that base case pricing is becoming too entrenched and probably it's wrong.
I like how you described it, a short-term cyclical growth push from China's reopening here. How transient do you expect that growth push to be? Is this something that's going to be a surge for a quarter or two and then kind of equilibrate?
I think a couple of quarters is what you need to look at here. Markets care a lot about the rate of change of growth and the rate of change of inflation, Adam. And here, you need to be honest, clearly you are going to be seeing a positive rate of change in growth in the short term. To give you some statistics, there are countries like Germany who are effectively the largest trade partner of China. So the moment China reopens, countries like Germany are going to temporarily benefit from it. Then Korea, Australia, all these open economies that are either geographically close or they have some direct business with China, they are going to benefit from it, temporarily speaking. Because the moment that the growth cyclical push is exhausted from a rate of change perspective, that's likely going to happen, say, in 6 months, Adam. You are going to go back into what are the secular drivers of growth. What is the long-term, what I call gravitational pull force. And from that perspective, you are still going south, both on a growth and on an inflation perspective. Now, the market here, Adam, is basically choosing to focus on the green shoots, both on inflation and on growth. So what it's doing is it's saying, look, inflation is going to come down very rapidly. On the piece on the macro compass, I highlighted that inflation swap traders, so the market implied expectations for inflation, are at 2.5% by late summer. So again, I want to repeat that late summer is literally in 7 months, and traders are pricing inflation in the US to drop to 2.5% by then. Wow, that's a rapid decline in inflation. So they're focusing on the good side of it. You know, if inflation comes down, Adam, that's great. It's great because the Fed has an easier life. They don't need to push so hard if inflation really comes down that fast. But they're also thinking that growth is going to be much better because China reopens. And so we avoid a recession. And at the same time, inflation comes down. That's immaculate disinflation. That's a soft landing, effectively a soft landing. And I think that it's a bit myopic to just take the green shoots coming from both angles, because let me give you another angle, for instance. China reopens. We have seen what happens to the supply chains of large economies reopening. That's the US, that's Europe, where you have temporary labor shortage because a lot of people are actually sick by COVID. So you have some supply disruptions. Then you have a lot of nominal growth activity. You have people spending, people consuming. You have the renminbi strengthening as well. So that seems to me like inflationary overall. Commodities are rallying, Adam, as we speak. Copper, base metals, they're rallying. Markets are completely ignoring that as if it doesn't matter for inflation, but they're extrapolating the growth side of it. So again, it looks to me pretty myopic, as if markets are choosing to focus on the green shoots that are there, but they are making the base case pricing very, very la-la land. That's how I would define it at this stage.
I'm kind of curious as to what's going to win out, right? The delayed effects of all the hiking and tightening that have done so far that have yet to arrive versus China's boost. Like which one, on a net basis, Are we going to grow? Are we going to contract as a global economy? And it sounds like what you're saying is the market is just like not even looking right now at the potential effects of what that delayed impact could have, but also if the Fed indeed does hang out, we have a much higher cost of capital than we've had in the past, and that's going to be highly restrictive to growth. I see you sort of reacting as I'm saying this. So it seems like you're saying the markets are really just not paying attention to that right now.
There is a chart in the article that looks at high yield credit spreads. It's a very simple chart. It's the spread of lowly rated corporates over treasuries. So it looks at the cost of capital for issuing debt for these junk corporates. The average level of these credit spreads over the last 20 years is roughly 500 basis points. So, if you're a low-rated corporate, you need to pay a premium over treasuries to issue bonds. That makes sense. This premium changes as the economy accelerates or decelerates. And, the more the economy is strong, the tighter the spreads are and vice versa. In a recession, Adam, these credit spreads are on average 1,000 basis points, 10% over treasuries. It can be 7, 8, 12, depends on the depth and on the rapidity of the recession and how bad it is. Right now, we're at 400 basis points. So again, guys, we are below the 20-year average. How can you tell me the bond market is pricing a recession? The bond market is pricing a very nice and comfortable soft landing. That's where we stand. What do I think of it? I think the recession narrative will prevail because the tightening of financial conditions has been extremely rapid, very, very vicious and strong. It takes time to work through the economy, and it's working its way. The pace of hiring is slowing down. Retail sales adjusted for inflation are negative. They're trending down negatively. So you have signs that all forward-looking indicators are looking at the recession, Adam. So we are slowly walking there, yet markets are choosing to focus on the growth impulse coming from China, ignoring the inflationary impulse potentially, and they are choosing to ignore the big picture, which is the economy is walking into a recession. We're basically pricing la-la land. That's how I would summarize it.
It shows the short-dated volume of the S&P as a percent of total volume. So these are basically trades that expire within 24 hours. I'm assuming that maybe then these are options trades. You're saying here more and more investors are treating the stock market like a lottery, right? If you just look at the growth of this, I mean, it's gone up fourfold in the past, if I'm looking at this correctly, 6 years or so, maybe even more than fourfold in 6 years. It just seems right now like it's a lot of hot speculation. This does not seem like something you would see in a market that's conservative.
Yes, and you are now slowly but surely bringing me to talk about our friend Jay Powell, because the chart you just referred to, Adam, is one of the many signs of the fact that animal spirits have not fully disappeared from markets. Yes, we have cleared excesses in a couple of places. House prices in the San Francisco Bay Area are down 30% from their peak, 30% down from their peak. Many unprofitable companies have gone bust. That has happened in the tech space, in the crypto space. So we have cleared some excesses. Definitely we have. But now we still have retail investors going and chase these 0 day to expire options, 0 DTE they're called, which are basically lottery tickets. You effectively overpay for these options and you have them expire in 6 hours. You get your adrenaline shot at the end of the day and try to see if you made money or not at the end of the day. That's one sign of animal spirits, but to take a step back and do it in a more broad way, if you're Powell, there's one thing you want to avoid here, just purely from a risk management perspective, which is a repeat of the 70s, where you relax too early, people say, okay, it's over, mortgage rates drop by 200-300 basis points, and you restart all over again the frenzy where people go out and buy a second house, a third house, they rent it out, they invest in whatever they can. Animal spirits. You want to avoid animal spirits. You want to refrain them. And if you ask me, animal spirits today are already a bit too loose and running hot for what's the Federal Reserve trying to bring down inflation. So I think just from a risk management perspective, Powell will have to do some homework and calm people down because it's getting a bit too soft landing-ish, la-la land, and animal spirits are back, and you don't want that.